I also need to, as a consultant, need to go on record with a disclaimer that this session, these materials do not establish a consulting relationship, nor do they provide formally professional advice or services. I hope this is all informative and useful, but when everything is said and done, the journey and the actions you will need to take are your own. And I also establish early on that I am not a CPA, nor am I an attorney, but as a specialist in this field and working around many in both professions, these perspectives nonetheless can be very useful. The SEC rule is about disclosures related to climate change. Back up for a minute. Climate change is unfortunately a matter of some controversy, but it really shouldn't be. It's a scientific fact that climate change is occurring. The Earth is warming. The effects are being felt different ways in different places. I read an article within the last week that ocean temperatures are setting an all-time record for the second year in a row. And if we boil the oceans, that's not good for the planet. It affects many different in many different ways. On the environmental side, we're familiar with tornadoes and hurricanes, extreme weather events, floods, prolonged drought, wildfires, everything you see there on the left. And as the ice caps melt at both poles, that's contributing to the rise in sea level, which has other collateral effects. And the environmental changes, in turn, produce social and economic changes, where they have influenced migration patterns, they've influenced trade routes. And investors and many stakeholders have seen for some time that all of these things eventually come back to companies in certain ways that affect their financial prospects, either in reporting periods or their prospects in the future in the short, medium, and long term. So climate change really caught the attention of investors a decade or more ago, trying to connect the effects of climate change to what's going on when it comes to the financial performance of a company. The last slide had many different types of impacts of climate change. The New York Times a couple years ago published this map on what are the primary risks of climate change in the US. There are wildfires, there are floods, there are hurricanes, there's sea level rise, and the primary risk differs depending upon where you are. But if you notice, every part of the US is colored in some way. So if you're an organization with operations or customers all across the country, climate-related risk, climate-related impacts could affect you in different ways, and it can affect your financial performance in different ways. So the background here is different depending upon where we go. So how did we get here to this SEC final rule? I put a timeline together here on some developments that have come from several different directions and ultimately confluenced to result in the final rule we'll get to here in a couple of minutes. The SEC reminded folks in the final rule that it was all the way back in 1982 that the SEC adopted rule for registrants to disclose risk factors. There's a citation in the rule in footnote 188. In 1998, a group called the Greenhouse Gas Protocol published the first corporate standard. Now, greenhouse gases are one of the causes of climate change. If you want to know how to calculate them or report them, there has to be a methodology. So the Greenhouse Gas Protocol set out to establish a methodology, and that's been out there now for over 25 years. When many stakeholders became interested in sustainability reporting in general, a group called the Global Reporting Initiative put together a taxonomy of all things sustainability, or as we might call it today, ESG, in terms of what should be reported, where would you put it in a GRI voluntary report. About the same time, many stakeholders, including investors, were pressing for regulatory action to reduce the amount of greenhouse gas emissions. There's seldom an appetite for sweeping new regulations in this country. So the nonprofit Carbon Disclosure Project was founded. Now it's called just CDP, with the intention of encouraging companies to voluntarily disclose their greenhouse gas emissions. They established a portal where companies can submit their CDP emissions disclosures. And over time, the standard or the information required in those disclosures has grown to include both the quantitative greenhouse gas emissions and qualitative information about organizations' efforts around managing and mitigating greenhouse gas emissions. And if you note, that's been out there for more than 20 years. In December 2009, the US EPA launched regulations to require mandatory reporting of greenhouse gas emissions for larger emitters. So companies in the utility business, chemical companies, large facilities are already disclosing, reporting greenhouse gas emissions, not to Wall Street, but to the EPA. As the investors ratcheted up pressure to get information in financial filings, the SEC issued guidance on financial disclosures of material climate-related risks. We'll see that word material a lot in the next couple hours and as you grapple with this rule. So that was a reminder, folks. In 1982, we started talking about disclosing risk factors. If climate is a material risk factor, you should be disclosing it, typically in the MD&A of your Form 10K. So a group called Sustainability Accounting Standards Board was founded the next year to put some meat on the bones of what those disclosure topics would look like. If folks can't figure out exactly what to disclose that investors are looking for, SASB undertook the effort to come up with those disclosure topics. SASB's remit was for all things non-financial, sustainability, ESG, whatever we call it these days. But climate is a piece of that, and SASB came up with some climate disclosure topics they recommended for companies if that's a material risk. The Greenhouse Gas Protocol expanded their guidance beyond Scope 1 and 2 into Scope 3. We'll discuss that in a bit, but Scope 3 guidance has been out there now for over 20 years. And if you fast forward to 2014, now the European Union started to get into the act and they issued a non-financial reporting directive that would require companies listed in the EU to submit standalone, let's call it sustainability reports that documented what was going on in performance on certain non-financial parameters. In January 2015, the Greenhouse Gas Protocol updated Scope 2 guidance. These protocols are accounting rules. Essentially, they are living documents. And as facts and circumstances change, as techniques change for conforming to the rule and coming up with emissions factor, the standards have been updated a couple of times over the years, and there's something to watch out for. That still wasn't enough. In 2015, the G20 and the Financial Stability Board zeroed in on climate once again and formed a group that ultimately issued standards in 2017 called the Task Force on Climate-Related Financial Disclosures. You'll see this TCFD a lot. And I bring this up because TCFD was not established by the Sierra Club or Greenpeace or environmental activists. It was established by the Financial Stability Board. because economists and financial professionals recognize that climate-related issues pose an existential threat to some aspects of the economy. And there was just a need, at the very least, to make disclosures around climate-related risk, with the theory, as it was for the Carbon Disclosure Project, that once companies start making disclosures, if you start to understand these risks, you're more motivated to mitigate and manage those risks. At least you know what they are. A couple years ago, Commissioner Allison Heron-Lee was getting a lot of input from investors that they were still not seeing the level of disclosures and financial filings they felt were necessary to make appropriate analysis for how climate-related risk is impacting registrants' financial performance and prospects. So she put the SEC's toe in the water and issued a public input welcomed to solicit comments on whether the SEC should proceed with the rulemaking process. I submitted comments on that, and many people submitted comments on that. And that was just really to create a baseline in terms of whether or how the SEC should move forward. On another track, about the same time, we've discussed already a number of different groups, the CDP, TCFD, all kind of zeroing in on the same disclosures of the same topic. And registrants, companies, and professionals, and even the people running these organizations were saying, enough already. You know, how many of these groups can we have trying to do the same thing? And in the space of just a few months, there were mergers of several organizations to establish common frameworks, common terminologies, common taxonomies for disclosures around sustainability in general and around climate risk specifically. So the IFRS Foundation, International Financial Reporting Standards, that governs all the accounting rules on a global basis, has a foundation that set up the International Sustainability Standards Board. And although you'll hear SASB still discussed in conversation, SASB is now part of ISSB. We'll still see CDP portals for reporting. CDP is now part of ISSB, and the lexicon remains unchanged because we're still used to saying it. But from the governance side, I think, and many stakeholders think, it's important and it's gratifying that these standard setters have listened and they're providing some relief by combining. So back to the US, on this side of the pond, the SEC proposed the climate disclosure rule in March of 2022. It weighed in at 410 pages. We did a webinar on that here at the Los Angeles chapter in April. And as it happened the next month, the UK required mandatory reporting on using the TCFD standards for companies in the UK. And that's one of several rules where the applicability, you have to look closely at the applicability. Does it mean you're based in the UK? Does it mean you're doing business in the UK? What is the threshold? That's an example of how many companies are pulled into compliance with these things, depending upon what the law or regulation says. Back to GRI, which is still voluntary. It did not go into the ISSB, but for companies who publish sustainability reports for general purpose use for marketing or recruitment or positioning or just for their own benefit, there is an increasing recognition that the content in there cannot be fluff. It really should be supportable and useful, applying many of the concepts that internal audit we're familiar with. So GRI went on record encouraging assurance for these reports. You don't do assurance for a marketing commercial, maybe to comply with FTC guidelines, but you don't get to the level of assurance for those kind of communications. Now it's being expected more and more for any kind of sustainability reports. ISSB issued some final standards on sustainability and climate just in June of last year. To me, this references that as companies start to wrestle with all things sustainability, there's really climate and there's everything else. So once again, the focus is on climate for the first disclosure rules on a specific topic. And that is in effect now for companies that use IFRS on the global stage. And just a few months ago, California, I think, surprised a lot of folks by passing laws, and the governor signed these into law for companies doing business in the state of California. They will be required to do these submittals. SB 253 requires preparation and submittal of a greenhouse gas emissions inventory, the quantitative side of carbon. SB 261 requires preparation and submittal of a discussion of governance, strategy, and risk management, which is the qualitative side of climate risk. Those categories sound familiar to anybody who has worked with TCFD, that the requirements of these two laws pretty much mirror the requirements of TCFD. And for once, California did everybody a favor that they did not put their own special brand of icing on the cake, as it were, that the requirements are pretty closely, if not exactly, aligned to TCFD. There are some thresholds for in terms of revenues of companies for $1 billion or $500 million on these two bills. But the threshold of doing business in California is pretty low. And that's a definition that goes to the California tax code in terms of payroll or asset value, and those are pretty low. So not long after California issued their law, out comes SEC with the final climate rule. And, you know, I put all this in the way of background and just to preemptively answer one of the questions I always get, when is this all going to go away? When can we make this SEC rule just disappear and not have to do anything about it? Well, my answer is it's not going away, and it just didn't happen a few weeks ago on March the 6th. That this has been the inertia for this is building for some time from many different quarters, especially driven by the investment community and driven globally. So SEC has entered the fray, and the requirements we'll get to a little bit more as we go. We'll hear a lot of terms as we discuss about the climate rule. Carbon offsets and renewable energy credits are sprinkled throughout the regulation. Won't go into them a lot today, but as a concept, many companies have already undertaken their journey to reduce carbon emissions, and there's so many other opportunities. There is a mechanism by which you can take action to compensate others. So, and we hear about planting forests somewhere else instead of doing your own pollution reduction effort. That relates to this as it goes to carbon. So that's about all we'll say about it today, but it's important to know that that is a thing when you recognize it and looking through the rule. There are several gases that cause a greenhouse gas effect in terms of trapping, you know, sunlight and heat that's not radiated back into the atmosphere. Refrigerants and methane are two that are extremely powerful, but the standard unit of measure for greenhouse gas emissions is called the carbon dioxide equivalent. You'll see that written as CO2e. GHG, of course, there's your shorthand. Scope 1 is direct emissions, as may occur from combustion, let's say in a boiler or furnace, or fleet emissions from gasoline or diesel-powered vehicles. Scope 2 is indirect emissions, where you purchase those emissions from somewhere else. Let's say you purchase electricity or you purchase chilled water. And Scope 3 is the big guy. That's all other indirect emissions that occur related to what your entity does, all the way up the supply chain and all the way down the value chain. There are 15 categories, and I've listed a few here on the screen. And there are ways that you can obtain information and calculate and disclose those emissions as well. So the final rule was released. It's 886 pages, 721 days after the proposed rule. Let's have some fun with numbers. Um, the word material is used over 1,000 times in the rule. TCFD is referenced over 250 times. You'll see the word term severe weather was replaced with a lot of different ways to describe what the SEC was talking about climate. Reasonably likely will call into play some kind of judgment. That's in there 78 times. Greenwashing is in there 30. ICFR is in there at 31. And there are over 3,200 footnotes throughout the 886 pages, and I have read every page. So more fun with numbers. The SEC and footnotes and the like included some information on what's going on out there already. We'll see the term large accelerated filers and accelerated filers. They're companies with over a certain threshold of market cap and other financial metrics, and those companies will know who they are. There are a fair number of companies getting assurance on greenhouse gas emissions reports, and many of those are coming from engineering firms, not accounting firms. So here are the disclosures. It makes changes to Regulation SK, which is in annual reports and registration statements. And there are new disclosures required under Regulation SX. As far as governance goes, some provisions are to describe the board of directors' oversight of climate-related risk, the processes by which board is informed. So there's a couple things there on the board. Those are narrative and describe management's role in assessing and managing climate-related risk. They provide a non-exclusive list. In my view, these non-exclusive lists are handy because those will be the criteria that people evaluate your disclosures by. What management positions are responsible? That's where those polling results we'll get to in a minute will come up handy. What are your processes to assess and manage climate-related risks? How management reports to the board? And as one indication of the SEC really did listen to those comments and provided some relief in the proposed rule, they would have companies identify the board member, the frequency of reporting to the board, the expertise of the board member. So a lot of that stuff came out. So what you see here on the left is a key provision. What happened on the right, maybe you think about it, but it was removed from the disclosures. On strategy, once you have identified the climate-related risk, a physical risk is something like damage from a flood or extreme rainfall event. A transition risk goes to maybe moving towards a low-carbon economy where there's a carbon tax imposed, for example, or compliance that just as the world changes around you, how do you transition your organization to adapt to that? So what is the strategy of the company to address climate-related risks? The initial rule would have companies disclose, or at least voluntarily disclose, opportunities, because for some companies, climate-related risk poses a business opportunity. That's pretty much removed from the rule. There was some concern about divulging intellectual property, so that's no longer part of the climate disclosure rule. If you use transition plans, then you have to disclose some matters about those transition plans. SEC rule has short term at less than 12 months, long term at more than 12 months. That's a little different from near term, medium term, and long term. The companies may be subject to for other disclosure requirements like CDP or California. But for purposes of the SEC rule, the dividing line is 12 months. On risk management, if the company described the processes for identifying and assessing risk management, how and whether climate-related risk is integrated into the overall risk management program, and the company should address, as applicable, how it decides whether to mitigate, accept, or adapt to the risk, and how the company prioritizes whether to address climate-related risk. So much of this should look familiar to folks in internal audit and compliance and risk. These are factors we've been dealing with, processes we have been dealing with all the time. Many companies have not yet integrated climate consideration into the enterprise risk management process. And you notice the rule doesn't require that you embed climate-related risk into the enterprise risk management process. If you have a standalone climate-related risk team, if you're doing it piecemeal around you can do risk assessment and mitigation however you like, but you must disclose whether or how that climate-related risk is integrated into the overall risk management process. There was a requirement in the proposed rule to even specify the location of your risk by zip code. There remains a provision for general descriptions of that might tie to the map we saw a little bit earlier in the presentation, that investors are getting pretty savvy about finding out where you have facilities located. They can do an overlay on that map and say, you have a lot of facilities here where drought is an issue. So let's look in the disclosure and see if drought risk is discussed and acknowledged, and whether the company has disclosed if they're going to mitigate that risk, accept the risk, seek alternative supplies for what depends upon water from that area, or adapt to it, or it's not there at all. So the provisions of this will enable analysts to look at disclosures and better consider how climate-related risk can affect the financial prospects of a company in the years to come, and whether or how they make an investment in your company. We see here one example of many things in the final rule where I call it an if-then, where the disclosure is not required unless you do something. If you do X, then you must disclose Y. We'll see a few more of those, and let's pay attention to that as we go forward. Well, the next one is right here on this slide. That if a company has established a target or goal that is reasonably likely to materially affect the registrant's business or the results of operations or the financial condition, then disclose them. So disclose the scope of the target, the unit of measurement, the time horizon, the baseline, where did you start from? How are you going to track progress? A qualitative description on how you will achieve them. And every year, you have to update your progress against those targets and goals. You've probably seen in the press some companies will declare coming after COP28 and as they signed on to climate accords agreement to comply in principle with the Paris Climate Accords, or to sign on to some other organizations or groups, will be carbon neutral by 2040. We'll achieve net zero by 2050. Top management in some companies, especially consumer-facing companies, have made some of those declarations publicly and then thought better of it because they didn't really understand what it would take to do it. Many companies are still on track for that. This is one section where the term greenwash appeared, that if you make a disclosure that investors do literally take these to the bank around targets or goals, and you have to be serious about it. Does it imply, a particular product line, facilities in a certain country, and what's the timeline? What is the unit of measurement? And then once you make that, by golly, you have to implement processes and procedures and monitoring, and you have to declare how you're going to track it, and then you have to make good on that and report that in your financial filings in subsequent periods. This is another if-then. Nothing says you have to establish a target or goal, but if you do, you have to make these disclosures. Greenhouse gas emissions, a lot of fuss about this, that companies have to prepare and disclose scope 1 and scope 2 emissions if material. There's that word again. This applies to large accelerated filers and accelerated filers only. You do not have to break out individual greenhouse gases. It's all CO2 equivalent. And you have to disclose your methodology, the inputs, where you get the data, what protocol or standard you're using. There's a phased-in approach that companies have a little bit of time to do this. The large accelerated filers do that for their fiscal years beginning on or after January 1, 2025. So these requirements are for disclosure of the emissions as aligned with fiscal year because it should match the disclosures in the financial reporting. If you have a non-January 1, December 31 fiscal year, you could be in for a little different work because some of those regulatory requirements we saw before are based on calendar year. So there's a little bit of a challenge for you non-December 31 fiscal years. One of the things that the affected community reacted to with glee was that scope 3 emissions are not included in the SEC final rule. I would note, however, that if you're subject to IFRS or the ISSB standard or the California law, scope 3 emissions are included, but those disclosures would not go in the SEC filing. Okay. We'll get now into the concept of attestation. The emissions inventories have to be disclosed, and investors want them to be right. So for folks who work around assurance all the time, this will be old news. But if you start talking about limited assurance and reasonable assurance, it's kind of hard to convey, and it's kind of hard really to understand. So the SEC, recognizing that, I think, did put this information in footnotes and in the content to remind readers of the difference between limited assurance and reasonable assurance as we get on this journey for attestation over greenhouse gas emissions report. And this took up a lot of pages in the final rule. What is the phased-in approach? If you voluntarily disclose the emissions and voluntarily obtain assurance, you've got to disclose the fact. No attestation is required for scope 3 emissions. One of the statistics we saw a little bit ago was that about over 2/3 companies who get assurance use an engineering or technical firm. That's still allowed. It doesn't have to be an accounting firm. It can be an accounting firm. It can be your financial auditor. And if it is your financial auditor, all the other rules of the road apply in terms of disclosures and independence and the like. This attestation does not require coverage of the effectiveness of internal controls, but one might imagine that some of that will work its way into the protocol. And in the footnotes, one commenter even went so far as to say, well, how can these assurance providers rely on the work done by internal audit? That was yours truly. And that's a hint, I think, that internal audit can look for a place to get involved here and add value to the organizations to reduce the effort on these attestation engagements. There are a couple other provisions that I'll mention here very quickly as we're getting into the home stretch. There are safe harbor provisions. Much of what was here is forward-looking, so you have safe harbor for forward-looking statements. And there are provisions for carbon offsets and renewable energy credits throughout the rule that I won't have time to go through here. But if your company engages in those, it's worth knowing that there are provisions for that. So in the remaining minutes, let's move to Regulation SX, which goes directly to the financial statements and the financial filings, that the company must disclose impacts from severe weather events and other natural conditions. That's a phrase that just comes trippingly off the tongue. You'll see that a lot in the 886 pages. And disclose the aggregate amount of expenditures as expensed and losses, excluding recoveries, and to disclose capitalized cost and charges recognized during the fiscal year. Both of these are measured in the aggregate as to whether there's a change of more than 1% from the prior reporting period, subject to the de minimis levels shown on the screen. And if that occurs, the disclosure, the footnote to financial, must also indicate where they're presented on the income statement and balance sheet. You cannot present this on a net basis. Recoveries are separate, just as they are in accounting rules for liabilities and potential recoveries from other parties, insurance companies, or business. And the attribution principle is introduced in the final rule. The commenters said, well, how do we know if something is contributed to by carbon or if it's caused by severe weather events? When the event or condition is a significant contributing factor, then the company is obliged to disclose the entire amount. So if you have a heavy rainfall event, a roof collapses, you have to replace a warehouse. Well, if the roof was already, 3 years away from the end of its useful life and it just accelerated that, was it really caused by the severe rainfall event? Well, if it's a significant contributing factor, the whole amount gets disclosed. If at the end of the day it aggregates to 1% with everything else from the results of profit, operating profit as compared to last year. The financial estimates and assumptions. There are some qualitative disclosures on estimates and assumptions that are materially impacted by severe weather events or other natural conditions. The rule goes into assumptions for loss contingencies, useful life of certain assets. Folks may be familiar with asset retirement obligations. If you have assets on the beach someplace as a resort company, and they have a useful life of 40 years, and maybe now the useful life is 20 years because of hurricanes. Well, now that asset value and the retirement obligations have changed, and you have to measure that again. You have to disclose those also, and if they exceed more than 1%, or if the change is over a certain threshold, those have to be reported as well. And there are contextual information requirements, and these numbers have to be reported and disclosed in a way that parallels presentation of financial information on financial statements for this year and prior year. And in the SEC clarified in the final rule that only goes back now to the first year this rule is required. You don't have to dig it through archaeologically and find what these would have been in prior reporting periods. So that was clarified. And this is different. The financial effects disclosure should be noted in financial statements. That SEC went on record subjecting these to and internal controls over financial reporting will enhance reliability. We're not going to exempt this from the financial audit or ICFR requirements. A note to auditors: apply that concept of materially as you do for everything else. As you do financial audits, there's no need to delay. This is required as of the effective date of the rule, which is now. Essentially, you can use specialists to help you figure this out. Must be included in the scope of the audit that the financial auditor submits when the registrant files financial statements. And there's no safe harbor, that you've got to get this right. This is very different from what we see in TCFD. And even the ISSB, the global standards, did not require these financial statement disclosures, the footnotes to financials. It's not required in CDP submittals. It's not required in the California law. And these take effect for the fiscal years in large accelerated filers for fiscal year beginning January 1, 2025, which means that you have to design and start working on those ICFRs, the controls in the ICFRs, pretty quick, because if anybody remembers what the early years of Sarbanes-Oxley were like, it was no fun when you wait till the last minute. So here we are with this coming up, and we're almost in April. So I would be remiss if I did not plug this document. COSO a couple years ago was lamenting the fact that the Internal Controls Integrated Framework, yay, it was widely adopted for financial reporting, but it was never intended to be only for financial reporting. It was topic agnostic. So COSO authorized an effort to come up with something that would help stakeholders see how the integrated framework can apply outside the financial reporting realm. And the result is the document we see here on the screen, a supplemental guidance released about a year ago on achieving effective internal control over sustainability reporting. I'm proud to say that I'm one of the 6 authors of this document, the only non-CPA and the only sustainability specialist. It was a year of tough work, but we learned a lot in putting this together. Even those of us who know this, we learned a lot putting it together. And the intent here is for this document to help build a bridge between those who know internal controls. Stretch here. So when does all this kick in? You know, now that we've been overwhelmed with all the stuff that registrants will have to do, when does all this kick in? I've put this in a couple of buckets, if you will. The blue, as it was on the slides, for the financial disclosures, in the financial disclosures and all others. There's a better table for this with a lot more detail in the rule itself. For purposes of this screen, I simplified it, but for everything except those middle 2 columns, the large accelerated filer has to do that for the fiscal year beginning 2025. The accelerated filer gets a year break, and everybody else gets a 2-year break so that you can learn from the people who go before you. The disclosures regarding material expenditures and impacts come 1 year later, and the greenhouse gas emissions, scope 1 and 2, kick in 2026. And I believe this is a lag from when the California rules will kick in, especially for those next 2 rows here, the accelerated filer and all other companies. There is a threshold in the California law in terms of a revenue threshold of whether you're triggered. Funny thing about scope 3 is because it goes outside the company into the supply chain and the value chain, if you sell to anybody or if you buy from anybody, you are somebody else's scope 3. So whether information requests for greenhouse gas emissions comes from a statutory or disclosure requirement, the requests up and down the value chain will pretty much eat your lunch. You'll be seeing some more of those.